Let's turn to big bank earnings. We got Morgan Stanley and Bank of America out this morning, both delivering another bout of robust results for Wall Street. Profits for both banks more than doubling in the fourth quarter, fueled by a resurgence in deal making and financing demand. Joining us now for a bit more, we want to bring in Mac Sykes. He's Gabelli Funds portfolio manager. Mac, it's great to have you here on set with us. So these two results this morning following on the heels of very robust results that we got yesterday morning. I'm curious what your big takeaway here from this earnings season and maybe what we are learning from big banks.
Yeah, I think when we go to 30,000 feet for a second, think about the backdrop for investing in banks today. It's pretty extraordinary. We now have a normalized curve, so instead of the inversion, so a pretty normalized real rate. We have regulations that are going to be easier, so that boosts M&A. We already, year to date, we have 100 billion of announced deals. And then the last, the consumer activity has been very good as well. So when you put it all together, it's a really good environment for investing in banks. And we've seen that in terms of the reporting results. JP Morgan, 20% return on equity, very strong. Wells Fargo, very strong results. And then this morning, both from Bank of America and Morgan Stanley, delivering on those results as well.
What are you extrapolating about the state of the consumer right now per these banks?
So, you kind of have to look at the different segments that they operate. If you think about American Express, it's sort of the upper tier in small business. But, Bank of America is a pretty good slice of America, but also in terms of their credit, it's a little higher end as well. And I think that's consistent with the economic activity, which is good household balance sheets, sort of normal retail spending, as we just heard. And just a continuation of the good trends that have been in place for over a year.
Mike, I'm curious, when you take a look at Bank of America's trading operations, didn't as much significantly exceed expectations if you compare it to a Goldman Sachs or something like that. Is that something to be worrisome about? I guess, what is the read through there?
Well, I think there's a little bit of segmentation too in terms of the products that they serve and the risk that they're taking in terms of the activity. And if you look at Morgan Stanley, 50% in trading, and equities really driving that. I think Bank of America, more fixed income component there for them. So, it depends really on the comparables. It depends on the concentration of that capital as well.
When you take a look at the net interest income, at least for Bank of America, are they more exposed or I guess more at risk if we don't see the Fed cut? And I guess what are the implications there?
So it's a giant work in progress, but what I will say is that, if you just look at the static NIM today, it's 197 for Bank of America compared to JP Morgan at 260. And so you can see there's a discrepancy in terms of that yield that they're earning off their major asset bases in terms of their balance sheets. And so, Bank of America has been hindered by some of these legacy investments that they made years ago, whether it's in the HTM, AFS. And so that's 900 billion in total that will continue to roll off and reprice. And so as they reprice, that's 150 plus basis points that will go into the contribution of NII. And so even though they're under earning relative to their balance sheet to some other banks, you're going to get a tailwind in terms of the repricing going forward over the next several years.